Good afternoon, traders and investors. Will back here with another one, coming to you with a Friday market recap. So in today's news, guys, markets ending green, largely off of continuation after the tech earnings rally of yesterday. But we got some jobs market data early in the morning, the non-farm payrolls jobs data that came in way hotter than expected, and it sent yields skyrocketing. That is just because as long as we have a hot jobs market, Jerome Powell may not need to cut rates as early as anticipated. The March rate cut is now largely priced off the table, and even the one for May is becoming more and more of a 50-50 probability. So traders are currently pricing in that new information. So we're going to take a look in today's video at the jobs report, how it affected yields and how it affected certain stocks, which are very exposed to interest rate fluctuations. We're also going to take a look at our major indexes. We're going to take a look at our major tech names as well. And lastly, conclude with my portfolio. I also have 3 earnings that we're going to cover for you guys that came up earlier in the week. We're going to be covering the names of MSCI. We're going to be covering the name of CP, Canadian Pacific. These are 2 of my favorite value plays in the entire market. They are growing, but they're very defensive plays with very large moats. That's why I absolutely love them. And lastly, we're going to be taking a look at SMCI, one of the crowd favorites and a very, very popular trade with retail traders recently. So we're going to take a look at their business model and determine, is this growth sustainable and is the stock still a buy? So without further ado, guys, let's get right into today's video. So SPY up 1.05%, QQQ up 1.69% on the day. The ones that got hit the most, guys, are the interest rate sensitive plays, namely your growth stocks in the form of IWM Russell. So let's take a look at exactly how the markets were shaping up here today. You will see that largely outperformance by big tech. NVIDIA up 5%, Meta up 20% after the earnings yesterday, and Amazon up a cool 8%. Apple largely recovering the after hours losses yesterday after their earnings report, ending slightly negative for the day. But the only red sectors in the markets here, guys, today, for the most part, is your real estate sector, which is heavily sensitive to interest rate increases, utilities as well, which is also an interest rate sensitive play, because traditionally utilities companies don't grow that much. Most of their attractiveness for investors is in their dividend payments. Now, if you can gain 4 or 5% buying a 10 or 20-year Fed bond, which has no risk associated with it in terms of price drops, well, you are better off potentially buying bonds than utilities that pay dividends of 3 or 4%. But as a whole, guys, market was fairly decent here today. Nice gains in healthcare and nice gains in financials. So we did have a fairly balanced market across the board on our major sectors. On the one-day relative performance, you can see that it was fairly mixed, with your technology sectors and segments coming in hot for the day after earnings yesterday, and the loss leaders in terms of your interest rate sensitive plays. So what exactly happened to make interest rates shoot up this morning, guys? It's very, very simple. It was the jobs report. So look at this jobs report. US January non-farm payrolls, 353,000 versus 180K expected. That is a 2x in terms of the jobs number. And usually the surveys and economists that make these projections are very, very accurate. And now they actually just got outshot by a wide margin. So take a look at some of the statistics here. We have a lot of revisions as well from your prior 2 months. November was also revised to the upside. December coming in very, very hot. Unemployment rate still good, 3.7 versus 3.8 expected. You love to see the low unemployment rate. Average hourly earnings were on the uptick. Slight little implications here for inflation, but as a most part, guys, inflation has been coming down, and I don't expect that these wage increases are going to be a permanent thing outpacing inflation, which could lead to a potential wage price spiral, which we've talked about earlier on the channel, which is a big worry for the markets. So as a whole, hot jobs data coming in and really ruining the potential of a March rate decrease. You can see the probabilities now for your 0.25% decrease on the rates are only down to about 20%. Now, a day ago, before this news came out, they were 38%. So you can really see the impact that that jobs report had on your probabilities for rates. And they're not looking that much better for May here, guys, as well. So take a look. Your probability for a 0.25% decrease coming in May at this point is only about under 60%. It didn't change that much from the jobs report in terms of a one-day change. Yesterday, it was virtually the same. But as long as we keep getting data to the effect that either inflation is sticky around the high 2% or 3% range and the jobs market is not tanking, well, the Fed may not need to decrease interest rates as soon as possible. But the jobs report does show that the economy is very, very healthy. So that's why a lot of stocks were on the upside, but most of the stocks that were on the downside were only the interest rate sensitive plays. So you really have somewhat of a bifurcation in the market right now between the plays that are sensitive to interest rates, which are being maintained low, not getting a lot of love from investors, and stocks on the other side that respond well to positive economic data, which is most stocks indeed. So before we get into more technical analysis here, let's go over some earnings, shall we? So we're going to start off the day here with MSCI. Now, MSCI, I've mentioned a few times on the channel. It is part of a little segment here in financials, which is your financial data segment. Now, you can't see my head's in the way. Let me move myself over. This financial data segment, guys, is one of my favorite segments in the market. It doesn't get talked about that much, but every single one of these companies has very high margins, a big subscription model, and basically are kind of untouchable at this point in terms of their stature in the market. If you take a look at most of the companies in here, you have S&P Global. They obviously issue most of your index ETFs, anything branded from SPY and all the way down. They have so many index ETFs and they collect a lot of revenue on those. It's a very wide moat for them. Then you have CME, right, which is also one of your exchanges. So this is just comprised of a lot of either exchanges as a whole, some similar to the New York Stock Exchange or whatnot, or just basically financial data provider companies. So most of these companies generate a ton of profit and are in a segment of the market that is relatively very difficult to enter for new participants. So a lot of these companies are very, very good in terms of long-term positional plays. You can see down here, MCO is Moody's, your rating agency. ICE is Intercontinental Exchange, an exchange that makes a ton of profit. MSCI is in there as well. You also have your NASDAQ, not the actual NASDAQ 100, but NASDAQ in terms of the exchange. They generate a ton of money. CBOE for your options board. And then FDS, which is basically fact set research, which I've presented in the channel in the past. So this is one of my favorite segments in all of the financial segments as a whole. The other one being credit cards. Financial data is my second favorite. I'm not a very big fan of US banks. I do think that there's not enough consolidation in the industry. I love Canadian banks because of their oligopoly stature, but this is definitely a close second pick for me after the credit cards, just because the businesses are so sustainable and they generate so much money. Now, MSCI had earnings earlier in the week and had a nice almost 10% pop after their earnings. You can see that they're currently doing one of my favorite breakout retest strategies that I present on the channel as well. So very, very, very big area of consolidation here. You can see that 570 was a decent area of resistance. We've now broken up above that. So I'm going to be looking for the breakout retest of the higher end of this range before potentially launching up higher. I will be looking to potentially add some shares of MSCI if we can really retest this lower $570 range. So MSCI, if you guys don't know, this is obviously one of the companies that generates a ton of money from their suite of ETFs and related products. So MSCI, you guys may have seen these before. They run a ton of either futures or ETF solutions for the emerging markets segment. So they have a lot of ETFs exposed to any other markets that basically aren't the US and Canada at this point. So Brazil, China, Southeast Asia, segments in Latin America, obviously. And they just make a ton of money from the fees that they generate in putting together these ETFs as benchmarks. So as a whole, you can see here that their profit margins are absolutely ridiculous. This current year that they just closed, they put in net operating margins of 58%. Very, very good indeed. Usually they hover around the 40% range, but it's always good to see a company that's so large still able to increase their margins as much as MSCI did. Now, let's take a look at their forecasts here for the next couple of years. You will see that they do have increasing EPS, which we love to see on the channel. We're talking between a range of about 10 to 15% over the next foreseeable future, and also revenue increases here of roughly 10% as well. So respecting my rule of 10% per year EPS growth and 10% per year revenue growth shows that the business is still expanding healthily. Now let's get right into the MSCI earnings call. So here you go. Here's the headline. Earnings call. MSCI reports strong Q4 growth, eyes future innovation. So here's your takeaways. Adjusted earnings per share increased by nearly 30%. Absolutely insane. Organic revenue and free cash flow grew by 15 and 24% respectively. So company able to generate a lot of free cash flow indeed. Equity ETF products linked to MSCI indexes reached a record of 1.47 trillion in assets under management. Non-listed products linked to MSCI indexes had nearly 3.2 trillion assets under management. So non-listed products could encompass anything from mutual funds to potentially fixed income solutions such as bond-related products that may not trade on the open markets for regular investors. Recurring sales in equity analytics hit a record for the high quarter and full year as well. So they also have an analytics division. Not only do they package ETFs for in terms of financial solutions, but they also have an analytics division for data analytics for financial firms, which is very, very good as well. Now let's take a look at their earnings, and you will see that this company, guys, is virtually bulletproof. One of the reasons why I love them so much. So here's the strong performance across region in the terms of the fourth quarter 2023 subscription run rate by region. Run rate is basically the current state of the business. So they give you the totals in terms of where they're at now. So you can see that Americas is nicely to the upside, plus 18%. EMEA is Europe, Middle East, and Asia. They're up a cool 15% year over year to almost $800 million. And then you have Asian Pacific division, which is as well up 14% year over year growth. Very, very good subscription run rate, total growth year over year in terms of that. Now you can see that they do a breakdown in terms of their lines of businesses. So here is the totals that you're looking for. You can see that there's 16% revenue growth across all of their lines of business. 11% is organic. Whenever you see organic, guys, it just means that that is net of any acquisitions. So a business has two abilities to generate revenue. Either they can do it on their own by growing their business, or they can do it by acquiring competition and integrating competition into their business. So this just means that they, of this 16%, only 11% of it was truly from growth from within MSCI, and the extra 5% came from mergers and acquisitions that they did over the course of the year. You will see that their index solutions is still their best performing division so far, representing about 55% of total revenue. You love to see the increase there. So all of this came from within MSCI. 12% revenue growth on a year-over-year basis. Their data analytics business is also growing fairly well, 7% to the upside. ESG and climate endeavors, which they've also been into here, is up 20% on the day. And then you have all other in terms of private assets. So they do a little bit of private counseling for firms and whatnot. So that is up a little bit, but not representing that large of a market share or in revenue share in terms of their total revenue stream. So fairly diversified business. They do have several different lines of business, but all in all, guys, this is one of the market leaders in the data analytics business and ETF business as well, right? Your main three are S&P Global. Then you obviously have BlackRock with their suites of iShares products for ETFs. MSCI is another one, and Vanguard is the last one. And unfortunately, Vanguard is not a publicly traded company, so you can only really invest in three of the major ETF issuers. Now, we also have a significant recurring revenue model with global client base. So here is your operating revenues mix. You will see that mostly everything is decently up here. Recurring subscriptions, always recurring revenue of 94%. This is a very big number, guys. The fact that customers return on an annual basis to the tune of 94% of all customers recurring in terms of returning for recurring subscriptions. It's a very profitable business model for them. You don't want to see businesses only run one-time item ticket sales. You really want to see the recurring subscription-based model. Emerging growth opportunities, you'll see that they're currently running very, very positive here in terms of all the divisions that they cover: insurance, climate, fixed income, futures and options, wealth and management, private assets, and ESG. So they run a lot of ETFs that are mainly based around the sustainable growth and for your environmental issues as well. So very, very good boost in pretty much all the different exposures that they have to these different industries. Very, very good. In terms of your summary of financial results, don't really need to present much of the balance sheet like I went over yesterday in tech earnings, because nothing much has changed, guys. They still run insane operating margins. They don't really have a lot of debt. They bring a lot of money to the bottom line. You can see here, very, very nice boost in net income over us. 87% boost in net income for the year. Extremely good. Growing EPS, right? So growing everything pretty much. Growing revenues, growing the bottom line, growing earnings per share for shareholders. That's exactly what you want to see here, guys, right? So here we'll see that you also have an organic subscription run rate growth of 10%. So that's what we were talking about before. In most of all their divisions here, all 4 of their divisions, they do have very stable growth across a whole. So MSCI is just an extremely solid company here, guys. There's really not much to say about the company in terms of how fancy it is, right? It's not a sexy company per se. It's more of a boring company, but all they do is just collect fees from their subscriptions, right? Collect fees from their ETFs, collect fees from their data analytics, and it doesn't cost them a lot of money to run the business. It's a very, very decent business to be invested in, and that's why I like them a lot. Now, you'll see that they only have roughly about $4.5 billion worth of debt, but they did put together a nice little slide for us here. It's a bit down. Let me see if I can find it here for you guys. But essentially, they're just saying that the unsecured debt maturity profile, right? So their debt only really matures starting 2029, 2030, 2031. And at that point, interest rates will be a lot lower and they can service that debt. The company usually brings in about $1 to $1.5 billion in free cash flow every single year. It's not currently listed here in terms of your trading view, but in terms of the last year coverage, they did bring about $1.15 billion worth of free cash flow. So they don't have a tremendous amount of debt. Their debt is maturing fairly later on when interest rates should be low in terms of refinancing costs for their debt. So all in all, very, very solid business, guys. I just love this company. The valuation is currently a little bit high at roughly 41.99 here. So about 42 PE on a trailing 12 month. But as a whole here, guys, the price to earnings ratio, as you can see on this chart, it's always been relatively elevated in the past couple of years, right? Usually prior to the pandemic and whatnot, it was still, sometimes it was in the high 30s and whatnot. So currently around 42, it is a bit high, but just to show you guys that in the last pretty much almost 10 years, it really always trades above 30, which just means the company is growing effectively and investors are willing to pay a premium for the company. Keep in mind, what do they do with all their free cash flow that they generate as well? Instead of paying down the debt, well, they do a decent amount of share buybacks here as well. You can see that pretty much in the past 10, 12 years, they've brought their share count down nicely. Roughly around 30% of outstanding shares have they been buying back for investors. So this is just a very, very solid long-term company to be invested in. Their business model is bulletproof at this point, low competition, and a very efficiently run business as well. Very, very high profit margins as a whole. So this is everything that I like, guys, right? They generate a ton of money, increasing revenue, increasing EPS, decent free cash flow, not a lot of long-term debt, and the business is really run efficiently by management. So really nothing bad about this company whatsoever. Now, let's get into our second earnings call, which is going to be Canadian Pacific. So Canadian Pacific, another one of my boring companies, guys, and I had to bring this one up because I am a Canadian here, and this is one of the best companies we have to offer to the world. A couple other ones will obviously be Constellation Software. If you guys don't know that one, Constellation Software, one of our great Canadian companies here, extremely efficient business as well. Look at this chart, right? Extremely nice company. And pretty much the other one is going to be Shopify. Shopify is a well-known Canadian company as well. We cover them whenever they post earnings too. So Canadian Pacific, fairly boring company, right? Just a railroad company, but extremely well-run business. And in terms of the long term here, guys, you can see that, this share price usually continuously goes up over time. It's a fairly no-brainer investment in terms of a more defensive value play. The company generates, despite being a railroad company, guys, look at these annual profit margins, right? We're talking anywhere between the mid to low, and even sometimes this last year, right? Very, very decent 30% margins across a whole. So you really love to see that. The company most recently acquired Kansas City Pacific, which gave them a larger distribution network. And you guys know the railway business is fairly impenetrable, right? You really can't start a new railway company nowadays. So it's only limited to a few players. And most of the players right now, it's really been consolidated ever since the Canadian Pacific, these guys acquired Kansas City Limited. They really did a great job of consolidating their network, and I'll show you their network, guys. This is a very, very extensive network here, and it ranges all the way down to Mexico. It's the only railway in North America that does have the 3-country connectivity in terms of that. So they service so many things, so many ports, and you can see basically what they're in the business of is they'll bring manufacturing products up from Mexico into the US and into Canada. And from Canada, well, they bring down to you guys all of our natural resources. So very, very decent company. If you're wondering why they're not in the western part of the US, well, that is their competitor, Union Pacific. This is Union Pacific's railway roadmap here as a whole. So Canadian Pacific, very decent company, decent fundamentals as well. Before we get into our earnings, let's take a quick little check here on your fundamentals. You'll see that since they acquired Kansas City Pacific here in 2021, you'll see that most of that was in terms of a debt offer, right? So they did offer some shares as well, but it was a share and debt package. So they basically paid, roughly here about $8 billion of debt, and the rest was in shares. So as a whole, company does have a little bit more debt running on its balance sheet right now, but does generate a little bit of free cash flow every single year. We're talking about 1.24 billion, not the highest free cash flow generation, but they do have significantly good net margins, which in the future is going to be allowing them to pay this down as they really start benefiting here from the benefits of that merger with Kansas City Pacific. You'll see that in terms of EPS after being flat for a while, after this merger and acquisition, they've now put in 2 years where they've basically been tying in both businesses together. And now you will see the impact on their EPS. EPS is going to be significantly up here in the next 4 years, which is why I like this investment right now. And also revenue is set to expand here at double-digit rates. So not only do you have double-digit EPS growth, but you also have revenue in the low single digits, so 8, 9, all the way up to 10+% growth. And the stock has been accumulating in this beautiful range for a significant time now. So I do think that it is poised to go on a bit of a rally soon. So I have been accumulating a bit of shares, and I've also played this one on the channel as well. So Canadian Pacific, we'll go over a few little things in their earnings. Not too much to go over, guys, because they are a fairly boring business as a whole. So not really fancy, not sexy per se, right? So here's our operating performance. You can see that they've been doing a great job. The management of this company is outstanding, okay? So here's what they've been doing. Finished 2023 with industry best train accident frequency. So they've been bringing that down. CP's been 17 years and the head of this metric right now. Strong network performance, gains across key operating and efficiency metrics, and they invest in safety and capacity to support growth. So here you have your improvements here in terms of operating efficiency. So average train speed, 6% improvement here versus your 2022. Fuel efficiency, 2% improvement as well. And you guys know these trains consume a lot of fuel. So even 2% for trains is very, very good. Locomotive productivity here is a 13% improvement. So their locomotives are becoming more efficient as a whole in delivering that merchandise. And average terminal dwell, this is how long a train sits at a terminal before departing the station, before being loaded and departing. You'll see that there's an 11% improvement. So all lines, all metrics here in terms of operating efficiency going up. And that's exactly what you want to see for the long-term viability of the business. You will see here that total revenue versus this is a bit of a misprint here. Well, that's not a misprint, but the word I'm looking for pretty much is a bit of a misleading number here. So total revenue up 53%, but keep in mind, they just solidified their acquisition earlier this year and they merged the two companies together. So on a combined basis, both companies together, your total revenue year over year is only up about 4%. They did have a lot of expenses to conclude this merger and whatnot. So that is also playing into the fact that, revenue is only up slightly. Their expenses were up a lot. So operating margins weren't that great this year, but they should smooth out in the next couple of years. And total revenue now that the networks are merged should be growing, as I showed you guys before, closer to 10% here. So as a whole, fairly decent performance, nothing really wrong to say about the company. So just taking a look at the free cash flow, guys, just to show you guys that they are posting free cash flow. So here we have the headline: strong cash flow generation on the quarter and the year, record reinvestment in the business, and 2024 guidance, double-digit core adjusted EPS growth, and a little bit of further CapEx as they continue to expand their network. But here's the free cash flow numbers, guys. You'll see that they did generate $2.1 billion in free cash flow for 2023. So very decent year as a whole, guys. It's going to allow them to pay down some of that $14 billion long-term debt that they do have. And the 2024 outlook was actually very good here, guys. So there's the reiteration here of your double-digit EPS growth, a little bit of CapEx here, and take a look at the long-term growth projections from the company through 2028. So high single-digit revenue growth, double-digit EPS growth for the foreseeable future through 2028. Capital expenditures of only about 2.6 to 2.8 billion per year. That's not that bad as a whole. adjusted combined free cash conversion of core adjusted combined income of 90%, just meaning that from their net income, they really want to bring 90% of their net income in terms of free cash flow to that number right there. Return to double-digit core adjusted combined return on investment capital. So when you give a dollar to the business, how much money can they generate from that dollar? So they'll want to be generating in the double-digit range, is what you want to see from any business. And now we have strong margin improvement through cost control and operating leverage. So very decent business as a whole, very nice margins, very nice revenue expansion, and the business is in an industry that is pretty much untouchable at this point. That's why I like them. They're one of the major players in the game right now, and you guys know in terms of freight and merchandise, it's a very, very network heavy endeavor to do. So that's why it's very hard for no new entrants to enter the market. So really working with almost a monopoly at this point in terms of CP. So I like this company a lot. And now lastly, guys, we are going to be covering SMCI. SMCI has been one of the favorite retail trades over the past year pretty much, and rising from the month of April all the way to 522%, so a 5x in share price almost over the last year. This also coincides at the point where NVIDIA released their new segment of income in terms of data processing for large institutions for AI capabilities, and SMCI has been one of the major beneficiaries of NVIDIA's rise. So how exactly is the company positioned for the future, and what exactly do they do? So let's take a look here at some of their financials. You will see that 2023 was a record year for them as a whole, and they're generating pretty much $7.12 billion by the end of fiscal year 2023. Very decent revenue expansion as a whole. Let's take a look. Is it going to continue? So you'll see here that yes, they do have consistent EPS growth. Look at this EPS growth by the company and look at their revenue growth as well. However, revenue growth should be tapering off into 2026 and 2027 as most of your large companies that they provide for come to scale. So this will make sense when I show you guys exactly what they do. If you guys don't know what they do, let us take a look together right away. So Supermicro, what do? All they do pretty much is they make storage solutions, rack storage solutions for GPU processors. So you'll see that most of their products are just in forms of storage and rack solutions for those GPUs that companies like NVIDIA, Intel, and AMD use as a whole. They also have some other things like motherboards and networking solutions to pretty much make everything run smoothly together. But as a whole, guys, that's pretty much all they manufacture, racks for GPU units. So stands to argue, are they a sustainable investment for the long-term future, or are they just going to be a byproduct of this large-scale AI ramp? Well, let's take a little look here in terms of their numbers, okay? So in terms of the numbers, they just reported very, very decent numbers as a whole. So you'll see net sales of $3.66 billion for the quarter versus $2.12 billion from the first quarter of 2024. So very, very good quarter-over-quarter growth. Gross margin of 15.4% versus 16.7%. So a little bit of a dip on gross margin. And they don't make that much gross margin here, guys, right? They only make about 9% net margins as a whole. That's not very good in terms of being a product manufacturer. You'd like to see this over 10%, so I need to see some improvement here in net margin. So one of the questions that you should be asking yourself is, how does a company generate so much earnings per share without generating that much earnings to the bottom line? Well, it all comes in the fact that they don't have a high share count. So earnings per share is obviously earnings divided by your shares. So let's take a look here at exactly how much earnings are they expecting. So for fiscal year 2024, the company is raising its guidance revenue from a range of 10 to 11 billion to 14.3 to 14.7 billion. So the midpoint here is about $14.5 billion. Right? And if you take a look here at the amount of shares that they have from their most recent earnings report, they only have about 60 million shares, which is really not that much at all. So if we do some very quick math to establish their earnings per share, it's very, very easy. We just take their total amount of revenue that they're forecasting for the end of fiscal 2024, which is about $14.5 billion. We do their net margin rate, which is roughly about 9%. That gives them total net earnings of roughly $1.3 billion divided by our share count, which is roughly 60 million currently. right? That's going to give us about 21.75. And you'll see that right down here, 21.75 is roughly the expected estimate for your earnings per share for the end of 2024, which for them ends in June. Obviously, we're off by a tiny little bit because we're using rough numbers and not exact numbers, but you guys get the gist of things. Most of this company's EPS boost has not really been from their bottom line expansion, just due to the fact that they have a low amount of share count. So one of the main concerns that you could have for this company is if they ever do any share dilution, that is going to severely impact EPS price. But as a whole, the company doesn't really do that much share dilution. They don't have that much in terms of share dilution over the past few years either. So it seems to be still quite safe. The management does issue fair amount of share-based shareholder compensation for their board, but it only expands about 2% per year, which is not that much. EPS expansion happens faster than your share growth happens. So that is always a good sign as well. So the company is growing very, very good. Let's take a look at some of their earnings and you'll see, guys, that the earnings were very good. So now you'll see that they're one of the industry leaders in terms of their product offerings. Supermicro on a very, very large upswing here into 2024 for their systems. Now, as a whole, their total IT solutions are path to $25 billion plus in terms of the revenue that they want to hit. So they have 5 times faster growth versus the industry average over the past 12 months. They're trying to be a total IT solution company, not only a server and storage company, as you can see right here. So they're trying to diversify their business with all the newfound revenue and profits that they have been. That's what you like to see, a company really trying to reinvent itself from what it previously was, enabling total IT solutions. Again, here, you'll see here as well, nice revenue expansion as a whole. Here's your revenue mix. Most of it comes from the USA as a whole. Total revenue on the quarter was still about $3.7 billion. So the company is expanding well. Revenue mix, you'll see that most of the revenue still comes from the server and storage system, those racks. Subsystems and accessories, still a very small component of their business as a whole, even though they're attacking a bit more. Now, here's another little fact here. Non-GAAP gross margin has actually been declining, right? So here they give a little bit of a factor as to why, due to focus on market share gain. So they're reinvesting here. A lot of their costs, they're doing a lot more R&D and a lot more expansion of their network. They're really trying to spend a lot of money to grow the different verticals in the business, but it is hitting them where it hurts in the margins here. So here's your operating expenses. This is exactly what I've been talking about. They've been running a lot more operating expenses as they expand their network and try to attack different market verticals. And that's why you've had a decent little hit here in your operating margins. Operating expenses increased due to higher compensation as well. So that's another little factor to take into account. Operating margins higher due to higher revenues. That just goes hand in hand here. So non-GAAP EPS, you can see that their EPS expansion has been very good and should indeed continue. And if we just take a little bit of financial ratios here, guys, so they currently are trading roughly right now on a trailing 12 months basis at about 45 price to earnings ratio. But if you take their current share price, which is roughly 575, and you divide it by 2024 ending, which happens in June, I'll remind you, right? So let's take their $575 share price divided by 21.6. That's going to be a PE ratio on a forward basis for the next 6 months of 26, not that high. And end of 2025, so about a year and a half from now, take a look at this here, guys. 575 divided by 27.92. Their price to earnings is only about 20.5. So can this company continue to expand in terms of their share price? Yes, but that's only, once again, because they don't have a very high amount of shares outstanding. So this price could go significantly higher, guys, in terms of that. They're not very expensive in terms of a forward valuation. Their revenue is expanding well. Their product mix is, they're trying to expand their product mix, but is it a temporary thing? I do believe so here, guys. I do believe that this trade will largely end pretty much at the end of 2026, as they had been forecasting as well. Revenues after that should be dipping. Most of the expansion for your AI networks using GPUs and whatnot are only going to be going through about 2025, 2026. And then really the drop off in terms of exponential gains starts to happen. So could this be still a good trade even from current prices over the next 2 years? Yes. But would it be a long-term set it and forget it position? No. But there is probably some money to be made on this stock as a whole. I do believe that the share price could have significant price increases still over the next 2 years, just due to the fact that they're growing so rapidly and their current valuation is not that expensive. So I hope that helped you guys understand a bit more about SMCI's business as a whole. Now, let's get right into our major technical analysis here for our major indexes, and we're going to do that fairly quickly and then dive into my portfolio. So let's get right into it. So SPY up pretty much 1.05% on the day. What were we looking for? Well, daily higher low was set after Jerome Powell's statements and new daily uptrend continuation in motion. So now at this point, daily uptrend simply continues. We're just looking whenever this move tops out, daily higher low, anything above pretty much 482.57. Not that high on the RSI in terms of the daily, but weekly is starting to creep up there ever so slightly. But the weekly chart's looking beautiful, right? Weekly trend expansion right here, just creating a ton of space beyond your previous all-time highs, which leads us to believe if we do get some extended consolidation at some point over the month of February with that seasonality, your previous all-time highs is going to be a very solid area of support. I don't think the bears are going to be able to get through that. 480 all the way down to pretty much 467 is going to be the mark to watch. But as of now, guys, bulls still in full control. Now, QQQ pretty much the same thing, right? After bears having set the daily downtrend here, bulls recapturing with a 100% engulfing move. So we'll see if they can maintain this V-shape into early next week and potentially reset the daily uptrend. At this point, any pullback, anything above 416.55, just looking for a daily higher low for further trend continuation. The weekly is also looking very good as well. So currently in leg number 3 of your weekly uptrend, and still QQQ very nicely above your previous all-time highs. So similar to SPY, if we do get any extended pullback in mid-February, stands to argue, guys, that pretty much your at this point previous resistance, which is now support 412 all the way down to 405 and 400, should be some very juicy support for your long-term bulls to start buying the dip. No red flags whatsoever, guys. QQQ really recovering nicely with the help of most of your tech earnings. So bulls still remain in full control. Moving on to XLF financials. XLF financials decently up on the day, right? But still kind of down from the previous highs on the week. But the chart still looks very healthy. We got the daily higher low yesterday. Now just looking for daily trend continuation, reacting nicely off of your 12 EMA. Not quite getting to our previous resistance, which is now support zone 38 down to 37.50. So bulls still looking good. Any pullback now, just going to be trying to make a daily trend continuation at this point, right? Break of the highs. But if we do keep pulling back, guys, need to maintain this low right here, 38.28. Lose that, it becomes a daily downtrend, and then we just be in for a little bit more of weekly consolidation. But as you guys have seen, right, this area should be providing pretty decent support, 38 down to 37.50. No real red flags in financials as a whole, guys. We're currently dealing with up head resistance between pretty much 39.50 and all the way your all-time highs. This is going to be one big chop zone, guys, right, all the way up to about $41. But financials looking good. I will be looking to buy the dips in some financial names, most notably credit card issuers, and most notably as well, the financial data providers that I have been running over earlier on in the video. Now moving on to XLV. XLV also looking very healthy right now, right? So trend expansion right now. Any pullback is just going to be looking for a daily higher low, anything above 37.23. Looking for the daily higher low. 12 EMA is right down there as well. This whole area, 140.5 all the way up to about 141, should be acting as decent support if we do come back for a pretty much first line of defense. And we are looking at overhead resistance levels, guys. We are pretty much almost at the all-time highs. All-time highs 143.50. Very, very close to eyeing those new all-time highs. Weekly uptrend is clearly in motion at this point with leg number 2 of this weekly momentum just getting started. So bulls still in full control here, guys. New daily uptrend is set. Just looking for a daily higher low whenever we do get a pullback. So healthcare looking very good. IWM Russell getting a bit hurt by your yield movement today after the jobs report. So normal that they were a bit down here on the day. 0.53% to the downside, but looking not too bad here, guys, in the grand scheme of things. So it's just still in consolidation mode at this point. We're still looking, it shows you better on the weekly. We're still just looking for a potential weekly tightening range. The big level for me is going to be 187.66. Cannot lose this. If you lose this, you set up a weekly downtrend, and that takes some time to reverse, guys. If you ever get a weekly downtrend, usually it does take a full cycle to reverse. We're talking about 3, 4, 5 weeks to eventually get your weekly uptrend confirmation back to the bulls. But if we do, for some reason, continue to draw down as Jerome Powell's rate cuts get pushed back further and further, well, IWM will become very juicy for me. 187 all the way down to about 181 is the target. It's the midpoint of this massive range we've been stuck in for the past 2 years as growth stocks have been largely unfavorable. And we're still dealing with this resistance area, guys, 200 to about 195. The bulls are just not able to break and close above. So still maintain that consolidation. In terms of the daily here, guys, right, little bit of a daily downtrend by the bulls, but we're still kind of holding this general area, right? The 192 area seems to be decent support, but there is obviously very much larger support down here at 187. So if the rest of the markets continue marching upwards and the Russell maintains quite flat, I wouldn't be surprised, guys. That's just a byproduct of having a most recent uptick in your yields. But for daily bulls to really be in full control, you'd need to see them recapture this and close above your 199 level, giving them a great chance at setting the daily uptrend, sitting on this massive area of resistance as support, and then continuing a daily uptrend to the upside. But I only think that Russell will get some lift once you truly have a better indication on when the time frame for that first rate cut is going to come. So most likely second half of the year should be a lot better for the Russell. And now lastly, the Dow Jones on an absolute tear here, guys, right? So such a consistent chart for the time being. So daily uptrend is still in motion at this point, right? So any pullback, anything above 37,800, just looking for a daily higher low for further trend continuation. The eye is on the 12 EMA on the daily here, guys. Unless we lose this in a significant fashion, the bulls just remain in full control the weekly as well. After a few nice weeks of consolidation in early January, that was a weekly bull flag. We had pointed it out tons of times on the channel, how we love to see a consolidation move at the top end of a move like this. It just makes a very beautiful bull flag here, and the bull flag now confirming with a second leg of upside on the weekly. So just keep that in mind. Dow Jones now significantly past your all-time highs. Past all-time highs is 36,800 down to about 36,400. Significantly off that now, so I don't believe this is going to be resistance. If anything, if the market does come down here, I'm expecting 37,700-ish to be the new area that the bulls will most likely be able to find support. So just keep an eye, guys, on your daily 12 EMA here. Dow Jones is usually a lot less volatile than the rest of your indexes. In terms of the daily, you can see that QQQ sometimes loses this 12 EMA on the daily. SPY is a bit more consistent with it, but really Dow Jones uses this 12 EMA the best. Now, guys, let's move into our major tech stocks right away, and then we'll do my portfolio. So Apple, very beautiful recovery after the earnings that they had yesterday. So they had a nice little drop in the after hours, but ever at the time the market opened, it was just full rally on the bulls. The bulls largely bought the dip. We did have a cut here, okay, of our lows. But with such a nice recovery, we're going to go ahead and label this pretty much a triple bottom for the stock. So really not a weekly downtrend set. We didn't have a close down below there. Still rejecting nicely from my sweet spot, 181 down to about 175. It's been proving to be a very attractive buy the dip area for the bulls, and I do expect that to continue. So now that your daily bounce is currently underway after such a big drop, we're going to be looking how high can your daily bounce get. For the daily bulls to be able to recapture a daily uptrend, the probabilities are as follows, guys. We need to have it recover at least to 187.82 and then as high as 189.89. Let's call it $190. If the bulls can get a daily bounce going all the way up to $190, it sets them out nicely to potentially have a daily trend reversal in motion. So we're going to be looking for the size of the bounce. Keep in mind overhead resistance now, that same area pretty much, 190 all the way down to about 187. Bulls looking fairly healthy in terms of your short-term recovery. On the weekly, still just tightening up in terms of this weekly time frame. No close below, still acting as support. So probably Apple is going to tighten up over the course of the quarter here. Their earnings were decent, but as a whole, guys, not growing revenue as much as investors would have liked. So it may take them a little bit of time to grow into their current valuation as revenue isn't expanding as fast as possible, which would just pretty much exacerbate this monthly tightening range that we've been talking about for the last couple of months at this point. So very possible Apple just continues to tighten up at the top, but looking good. Always love to see Apple tighten up at the top end of a monthly move. They do that more frequently than you would imagine. So just keep an eye for that on Apple. Now moving on to AMD. AMD looking very good here today, 4.21% to the upside, pretty much rallying off the back of the rest of your tech earnings. Not much happened in terms of semiconductors. So we were looking for a loss of the daily uptrend here. They lost the daily uptrend, but never setting the daily downtrend. So we're going to be looking at the size of the bounce. Now, in one day here, guys, the bulls able to put in a sizable bounce over your 618 level, which means that the bulls are set up nicely to either V-shape or reset the daily uptrend to the upside for further trend continuation. Bulls in full control using your previous all-time highs, as support this week. 164 all the way down to pretty much 158 was the area that we were looking for. Very healthy on the weekly at this point. The one main thing with AMD, guys, is I just did not like their earnings. I really did not like their earnings. After an earnings like that, I would have maybe expected the stock to potentially be down 5 to 10%, not up. Not up subsequent to their earnings, but as a whole, guys, after their earnings came out, they did drop that 8%, but I was expecting an 8% drop maybe in one candle with some follow through, but Bulls able to recover nicely. Expansion from this stock, I'll reiterate, the expansion came from your price to earnings multiple expansion, aka speculation. It did not come from improved fundamentals in the business, which is what we wanted to see. They've been touting that the fundamentals will improve, but it's not going to come for a few quarters yet. And we'll take a look at the forecast here. You will see that the real growth only truly comes Q3, Q4 of this year. So investors getting a little bit greedy on their bets here in terms of AMD bidding up the stock largely before it comes into that further EPS expansion. And even with EPS expansion, guys, even with the end of year forecast here, right, of about 365 for end of 2024. I mean, the current price right now, right, 177, let's say, 177 divided by your 3.65, that's a PE ratio of about 48, guys. It's like literally twice NVIDIA's PE ratio, even if NVIDIA is at $660 right now. So AMD, fairly expensive. Now moving on to Amazon. So Amazon stock having a very beautiful day off of continuation from their earnings yesterday, pretty much flat, right? They pretty much had that earnings reaction after hour and then maintained pretty much flat over the course of the day, but everything looking beautiful coming up into our area of resistance, which we pointed out on the weekly, 165 all the way up to about 171. We're battling with it now. If we get through this most recent area of resistance, keep in mind, this is where Amazon struggled for a very long time, right? This whole range that they were stuck in for a very long time past there, they got above it a few times, but you see the difficulty in really closing above this previous $170 area and maintaining above it. So we're currently dealing with that same spot right now. If we do get through this area and start closing into the mid 170s next week, well, we're going to be eyeing the all-time highs, guys, of about 187. Looking very good on Amazon. Daily bulls, full control at this point. Any pullback after earnings, daily RSI, not even overbought that much just yet, even after a significant rise after earnings. So daily bulls, full control here. Any pullback, just going to be a daily higher low, anything above 155. Just looking for a daily higher low for further trend expansion. Weekly is looking very juicy with this weekly close. You would expect continuation potentially into next week. But if we do pull back here, guys, everything looking healthy, anything above 145, just looking for a weekly higher low, even if Amazon does consolidate. Beautiful weekly uptrend and also very nice monthly uptrend in motion as well. So we're going to keep an eye, guys, that whole all-time high area currently coming up into it quickly. Now moving on to Google. Google had a little bit of a dip on the morning into our area of support and bulls rejecting nicely. So 141 down to 138 was the big area of resistance, which is now support that we were looking for the bulls to play defense in. And they did play defense beautifully in the morning. So you can see this sharp hourly decline at the open into that area and bulls just buying the dip right away. So potentially looking for the hourly trend change. If we can get an hourly trend change into next week, it means your daily bounce will be underway. Then we'll be looking for the size of the bounce in relation to this most recent move. If we can get all the way up to about 149, that would be best case scenario. It will give the bulls enough space to reset into a daily uptrend. So going to be looking for that for Google, as they did lose the daily uptrend. They lost the higher low right here, right? Nice daily uptrend, loss of your low right here. Now, not a daily downtrend yet. Daily downtrend would be a low bounce and then flush of the lows. That would be daily downtrend for further weekly consolidation. But I am expecting investors to buy the dip on Google. I like their earnings, even though the market didn't like them. And this area, guys, 141 all the way down to 138 is very solid support. Moving averages are there as well. So I do expect the investors to start bidding the price up into next week, especially if we continue on this streak here of green markets. So just keep an eye out on that for Google. Everything's still looking decent, not losing any major levels. Loss of major levels will really come if we start closing some weekly candles below 137. That wouldn't be very good for Google. It would mean that we're most likely in monthly consolidation, but tons of space. Anything on the monthly above 121. Just monthly higher low for further trend continuation. So Google lagging a bit behind the rest of its peers here, but still looking fairly good for 2024 as a whole. I'm still expecting very good things from the company. Now moving on to Meta, guys. 20%. It was as high as 485 on the day here today. And Meta is actually not that expensive with the earnings that they just posted. They're trading at a PE ratio of 26. Only 26. That's actually not that high, guys. Meta has traded often in the plus 30 plus PE ratio range in its company history. So you can see that EPS will be expanding over the next couple of years. If you want to take the end of 2024 multiple, even Meta at 475 right now, the end of 2024 EPS, so forward EPS, forward PE with their EPS of about 1932 is going to be about 24.5. So really not that expensive. Even though it's rallied a ton, it's actually not that expensive. They make a ton of money. We went over their earnings yesterday. Their earnings were flawless. Very, very good. In terms of the technicals, bulls, full control at this point. Any pullback as soon as you lose your hourly trend, right? Let's say we set an hourly downtrend into next week consolidation. Just looking for a daily higher low, anything above 387.50, going to be for a daily higher low for further trend continuation. Weekly is looking absolutely ridiculous. Gorgeous weekly uptrend at this point. The next area of resistance, guys, psychological number, $500 is going to be the mark for Meta, and obviously beautiful monthly uptrend as well. They're really just getting back on the path that they had pretty much like pre-COVID. They're starting to get back on that path now as if this never happened. That's just because they've recaptured the essence of their business. They're making money like they used to. They're focusing on their core advertising business, generating high amounts of free cash flow, not a lot of debt, great margins, everything is going good. So they're really just recapturing the same slope that they had prior to the pandemic. So Meta really back on track here. I would be potentially interested in adding a bit more shares of Meta. I'd like to get a little bit of a dip because on the technicals, we are severely overbought here right now, guys, right? On the daily and on the weekly as well. And you can see weekly RSI is currently at about 88. It doesn't get that high in terms of Meta's history. Look, we have to go all the way back here to, let's see, right? In terms of the weekly RSI, this is actually the highest weekly RSI that we've ever printed. In terms of the daily, right? In terms of the daily 87s, you'll see that they hit 87 once earlier in 2023 after their phenomenal earnings back here. It peaked out at 87, then kind of dropped off after earnings ever so slightly. And before that, guys, you really have to go back a extremely long time. So in most recent history, only once did they hit that over the course of this year and they pulled back. So I will be looking for a potential technical pullback on Meta, and then I will be potentially initiating further long-term positions because their growth through 2028 is just fantastic and they make a lot of money. Now moving on to Microsoft. Microsoft also looking very good after today, up 2%. So nicely recapturing the loss that they have after earnings. So Microsoft, right, daily higher low is set after their earnings candle. So now going to be looking to set a new higher high and just really continue this daily uptrend. If for ever which reason we get a drop, need to protect 397.54. Lose it, you lose the daily uptrend, daily downtrend would be set. You'd be looking for weekly consolidation, but so far so good. Looking good on Microsoft. Going to be looking for them to take out these highs and just set a new daily higher low. Daily looking very good. Weekly time frame as well. Weekly uptrend after this consolidation. Weekly uptrend is well in motion. Microsoft getting a little bit overbought on the weekly as well. Most big tech, except for Tesla, most of big tech, guys, is getting a little bit overbought on the weekly. So we could be expecting a little bit of pullback here after our earnings season has concluded for the rest of the market. And we get into a bit of a lull period before we don't have any more Fed meetings until in March pretty much. And after earnings, there'll be a bit of a lull period. So maybe end of February, early March could be that period where markets just choose to consolidate. So that's what I'm looking for Microsoft. Microsoft becomes a buy for me, guys. If we can really revisit areas at this point, pretty much in the 390 down to 380 would be an area where I play Microsoft myself. Now moving on to Netflix. Netflix looking very, very decent here, guys. Just consolidating after the top end of its move on earnings. But just keep an eye on these lows here, guys. 562.46. We're almost there. I know it's very tiny, but if we do lose that, it would be a slight daily downtrend into a bit of weekly consolidation. But Netflix can afford it. Look at this beautiful weekly uptrend right now. Any weekly pullback above 462.50. Just going to be looking for a weekly higher low. And as usual, I've said in the previous videos, Netflix still battling with this range here, guys. Unable to close above 575. The top end of this range right here was a big area of consolidation, 2020 and 2021. Stock was not able to push past. So it may just be due for a little bit of consolidation before making a second attempt at that. Obviously, they could do it right next week if we just continue with these bullish markets. Netflix can just shoot up. But the fact that a lot of big tech was significantly up today and Netflix was a bit muted just leads me to believe that Netflix is potentially in now consolidation mode, just very healthy consolidation as a whole. I love Netflix per se. If they get anywhere close, guys, to the lower $500 handle, that is when I'll be making additional plays on Netflix. Now moving on to NVIDIA. NVIDIA up 5% on the day, pretty much for no reason whatsoever. But anyways, just off the back of the rest of big tech, no big headlines on NVIDIA today per se. They just are investors are very bullish leading into NVIDIA's fourth quarter earnings, as they should be, right? So NVIDIA just continues right now. Daily higher low is set at this point, consolidation range right here, right? So 605 we'll call the new daily higher low, coincides with your 12 EMA. Any pullback at this point, just going to be looking for a new daily higher low above this level, 606.50 pretty much, daily higher low for further trend continuation. Earnings going to be a very big one coming up in about 3 weeks. NVIDIA, very healthy weekly breakout pattern as well. Getting overbought on the weekly, but look, it's NVIDIA. NVIDIA can stay overbought on the weekly for a considerable amount of time. So we will just be looking here, guys, in anticipation of earnings. If ever we get a significant decline before earnings, let's say in the next 2 weeks before earnings, if we can really revisit under the $600 level, I may even be tempted to make a little bit of a play on earnings, because NVIDIA, even at $660, guys, it's not as expensive as it seems. I was saying this back in the $400-500 range, but it's still not as expensive as it may seem, right? I just did the AMD price to earnings ratio. Look, right? So even at about 600 and what is it now, right? $660, let's say. So let's take the price to earnings ratio on NVIDIA currently. So NVIDIA current price to earnings ratio with 2023 estimates, that's going to come in at the end of pretty much February 21st when they have earnings. So 660 divided by your 12.33, right? About 53, but the real gains come in 2024, right? 2024, if we take their EPS ending here, 660 divided by 21.09. So for the next year, they're going to be bringing down their PE ratio to about 31. 31 is fairly decent for NVIDIA. Now, it's not the same as when we had it under 500, but still not that expensive as a whole. It's getting pricey, but it's not expensive as a whole. So NVIDIA just looking very, very good. Going to be looking for a bit of cool down from NVIDIA. Undoubtedly, areas of potential resistance is going to be your 700 psychological area. For a potential area of resistance, since they're really beyond any form of all-time highs right now and just significant daily rally from pretty much early January. Now moving on to Tesla. Tesla just continues to struggle at the lower levels here, guys. At least we're not flushing our post-earnings lows of 180.88. But we're really close to doing that, right? So if Tesla flushes these lows, it'll just be daily downtrend continuation. The size of this bounce after earnings was relatively weak, which is why we were expecting a retest of the lows. Now, it's good that they've been holding the lows now for the past couple of days, but need to see the bulls put in a little bit more work. If you get a crack of 196.50, that would be new daily uptrend set. And then we're going to be looking for the size of the bounce in relation to our weekly leg down. It's going to have to be a heck of a bounce to start potentially reversing this into a weekly uptrend, but we'll see what happens. Tesla's still obviously very sensitive to interest rates. If Tesla stays down here, it just gives me more opportunity to play the stock, and I will be looking to play the stock over the course of the next week, anywhere between pretty much your 180 and 167 level, as close as I can get. Confluence between your downtrending channel line and your area of horizontal support that we had back here in early 2023. So we'll be looking to make some plays down there if Tesla continues to trade downwards, but Tesla just not looking very strong at all, guys. Extremely sensitive to interest rates, and that's why largely down on the day again. After that jobs report, Tesla just a very cyclical business right now, not positioned the best at all. So we'll continue to monitor this, but you know, if we do get lower low continuation, I would not be surprised at all. The size of this bounce was fairly weak, so we are expecting potential lower low continuation as we just perpetuate oversold conditions right now. Lastly, Palantir. Palantir up nicely on the day, 4.23% in anticipation of earnings, which comes out Monday after the close. So they were up very, very decently, trying desperately to reverse this daily downtrend. That would be a break of 1720. Limited price action going to be available for earnings, guys, right? It's either going to go one of two ways, Palantir. Either we're going to flush these most recent lows, which coincide with your weekly lows as well, and that's just going to perpetuate this weekly downtrend that we're in right now. And then we're going to be looking for further support, $15.50 down to about $14, as close as possible to $14 is where I want to average into Palantir. Or we're going to get a break of the upside at the upside portion of this, about 1833. Expected move on Palantir is about 14 which is fairly high, right? So 14% can really put us either way at this point. It can either put us at the bottom end of this range, or it could put us way above here, all the way back into pretty much your $19 range. So if we recapture to the upside, that would mean that your weekly uptrend is recaptured. And then we'll be looking, guys, for potential monthly trend expansion higher as Palantir makes another attempt at the low $21 range. So everything is going to happen with earnings, guys. Limited price action before there. I could do a bunch more technicals now, but it's not going to matter with such a high expected move after earnings. Just looking, break to the upside would just confirm a new weekly uptrend and maybe give this one legs to move higher into the $21 range. But if we get a disastrous result, we're going to really be looking for that lower $14 area to be playing as big support as it had over the course of 2023, and should be a decent level to average into positions. Now moving on to PayPal. PayPal also, price action fairly muted. Wednesday is going to be their earnings call as well. So we'll see what they do there. But as we were calling, guys, as soon as this downswing happened right here, I was saying on the channel, I wouldn't be surprised if this develops into a tightening range before earnings. And that's exactly what has happened, right? Tightening range before earnings, a little bit of the volatility going away as people are baking in expectations for what's going to happen to earnings. And I think it's going to be very simple, guys. PayPal should have a decent move on earnings. To break to the upside, break to the downside is roughly the same from current levels, right? So we're talking about 9% to the upside or about 9.5% to the downside, really in the middle point of this range. And there are two crucial areas, just like Palantir. If we lose this level, guys, we unfortunately lose the series of higher highs and higher lows on the weekly. This weekly chart is going to be why this is such an important earnings call for PayPal. We are looking for the weekly trend breakout here, right? Weekly trend breakout and breakout of this downtrending channel that we've been in for the past 2 years. If we get a break of the top end of the range, $68, and close high next week, it'll be a clear break and close above your downtrending trend line. And then I do believe the stock is going to be getting some major action from a lot of technical based traders. And in terms of your downside, well, that represents our big area of support, right? $60 all the way down to about $57 is the area that we are targeting. Wouldn't want to see bulls lose that, because if we lose that, I'll go back to the weekly. I'm sorry, I keep having to stretching this out. It's just PayPal's been down so much, right? So if we lose this area here, guys, we'll be losing weekly structure and we'll be losing this beautiful weekly uptrend. Flush of the lows would be a loss of the weekly uptrend. And then we'll be looking for a weekly lower high. How high can the bounce get? If the bulls get high enough, can maybe reverse this into the next quarter. But if it gets too low here, guys, weekly downtrend may be inevitable heading towards the $50. It's all going to be on free cash flow, EPS, and margins. Can they grow them for the business in 2024? They have no problem generating more revenue. It's just they're struggling with how much revenue they bring to the bottom line. Look at this decline from 2020 here after they had a lot of pulled forward demand in 2020 and 2021. We're now back under pretty much pre-pandemic levels of net margins, 13-14%. As of 2022, only 8%. And as of the last quarters, guys, we're back. We're back to 13-14% now. So this needs to be maintained. We need to have clear indications on what the CEO is going to do this year with all of his new advancements that he's been pushing in the media as of lately. We need to see how those translate into improvements in margins and free cash flow. So hope you guys enjoyed all of that. Now let's take a look at my portfolio. So taking a look at my portfolio here, guys, you will see that we are still underperforming the indexes. January has definitely not been a very good month for us, but ending the week pretty much at minus 2.25% on a year-to-date performance. Now, we are still affected by interest rate sensitive stocks and China sensitive stocks as well. So going to be looking to recapture a lot of this last value in the month of February. But as a whole, guys, the last 2 weeks have been significant weeks in terms of premium generation. We've generated a lot of premium in the portfolio, either writing puts or writing covered calls against existing positions, and brought our average costs down a lot. So stands to argue that when we do have some underlying share price recovery in the portfolio, this thing should really start accelerating to the upside, which is what we're looking for. So we're positioned very well, just still negative on the year. Now, moving into the positions, you will see that we do still have some CSIQ calls on deck. So let's tackle those first. So CSIQ, we had the, for this Friday ending, we had the $24 calls for 58 cents. They ended worthless. So I took it upon myself to write more calls for next week. $23 calls. CSIQ, obviously an interest rate sensitive play. It's a solar play, so really getting hit. And you can see, guys, how we've managed the position. Just look at all of this premium that I've been writing ever since being assigned on August the 4th. So if you had one average down, initially got assigned at $35 and now averaged down once at $25, and I've been writing a bunch of premium in between. Now that's very decent performance here, guys, because considering the fact, if you would have only tried to average down with shares, let's say you got assigned at my price, right? Let's say you got assigned at 35 with 100 shares, and then you tried to average down at the bottom of the market. Let's call it about $19, right? 35 plus 19. Divided by 2, you would only have an average cost of about 27. Now, with the additional premium we've been writing, we've brought it down to about 25.69. So we've been doing a great job here of really writing as many options as we can against the position to just drop this average cost. And you can see here, it's been a fairly challenging experience because CSIQ from our original assigned price, right, is currently still down roughly about 37% per se. But all in all, very happy, not expecting this stock to really have a lot of lift until interest rates really start coming down, or the expectation of rates really start coming down. So that's why I'm writing calls so close to the current share price, guys. I do think that any single rally in this stock is just going to be eventually sold off, and the stock is going to maintain a range in the lower $20 area for the foreseeable future until interest rates come down. So that's why I chose to write the 23 calls for next week for 1%, once again, further bringing down my average cost. Now moving on to Palantir. Palantir earnings play, we do have 200 shares assigned at $18. So we wrote some covered calls for them next week. With such juicy premium in them, I had to take the risk here, guys, of writing covered calls. If we do potentially get a massive share expansion, that's okay. My average cost is down to $16.67 with those contracts that I wrote for 65 cents as a whole. So 2 contracts, 65 cents. We'll see how the shares perform next week. But if we do get called away at $17.50, let's say, that's okay, guys. $17.50. You know, in relation to our average cost, that would still be a gain of roughly 4.5% and very decent performance on a week over week basis as well. We'll do that calculation next week if we get called away, but fairly happy in how much I've been able to reduce our share price here. Now moving on to PayPal. PayPal, I do have these $64 calls on deck, and I'll be honest with you guys, before earnings, I may just take a chance and take these off, even if I have to close them for a slight loss. I want to give one more chance to PayPal to really put out an insane earnings report and really start gaining the levels on the weekly. So we may even be looking for some leap options over the course of next week prior to earnings to try and make a little bit of an earnings gamble. I really think that this quarter is going to be make or break. It's either going to reiterate the fact that PayPal has a lot of work to do, or we're going to get some really positive news out of management and out of the financials, which could send this stock on a potentially extended rally into the $70 range. But as a whole, 64 calls on deck right now, got $1.63 for them. And you can see my PayPal average cost after being assigned right earlier in August, we're pretty much down from $67.50 all the way down to about $62.45 is our break even. So we're right at our break even now. Even if we do get called away at 64, I know it's not that much of an increase in terms of percentage gains, right? Only about 2.25%. So that's why I may be looking to take the gamble on earnings. All in all, fairly happy with my break even cost as of now. So even if it does take a tumble after earnings, it would be a decent opportunity for me to average into the stock and average down, as I do believe in the long-term story recovery for PayPal. But since it is a relatively short-term trading account, we really want to try to rotate the positions more often than not. Now moving on to Amazon. Amazon, we had the 146 puts for earnings. You can see that they ended worthless. So we got about 0.5% for the Amazon 146 prior to earnings, and now the stock is about 170. So no. That's why it's pretty much worthless right now. So pocketed all that premium. Google is one that we actually got assigned today. Now you can see that right here. We wrote the 145 puts for today for about $1, and now Google unfortunately closing below a 145. So we are now assigned 100 shares of beautiful Google stock. Really don't mind this assignment, guys, right? So we got assigned at 145 minus your credit that we got for the puts of about $1. So that means our average cost is about 144. And we chose to wrote the 145 calls at the close pretty much today for $1.16. So now our average cost is pretty much below 143 at this point. So we'll see if we get called away on Google if they close above 145 next week. But this could be a very quick in and out play on Google. I never recommend to play earnings plays, guys. They can go either way. I just really liked Google at this level, the 145. So don't mind being assigned on it at all. Now moving on to Starbucks. You can see that we have the 94 calls for next week that we wrote for 76 cents. So Starbucks, Right, Starbucks as well has been a play where we got assigned earlier on back in December here for $97, and we've been doing a great job here of reducing our average costs by writing some premium. Now, prior to earnings, we had the 96 calls for this Friday, which expired. We rolled the position, as a matter of fact, which I hinted at earlier on in the week. So we were able to pocket most of that, and then we did write the $94 calls for next week. Now, our break even is standing roughly at $93.58, but pretty much similar to what I was saying on PayPal, guys. I really want to be able to rotate these positions more often than not. So we're going to be playing some aggressive premium on these, and we do end up collecting a dividend over the course of the next week of about 57 cents as well. So that drops our average cost too. If the stock for some reason rises into next week into the $94, $95 level, we'll try to roll those 94 calls as best we can to generate some premium. But I wouldn't mind, guys, even taking just a small win and just resetting the buying power for these shares here in the account. In my opinion, guys, it's going to take Starbucks a little bit of time to recover all the way back up to 97, unless we have a substantial increase over the course of the next 2 weeks. But their earnings were not the best, guys. They still have a little bit of issues to be working through. So that's why I'm not expecting some massive share increases, which is also the reason why I don't mind writing calls so close to our break-even price right now. It's still above the current share price right now. So we'll see if potentially Starbucks opens a little bit negative on Monday. We may be able to take profit on these covered calls and maybe wait for the stock to rebound a little bit here so we can write a bit higher. But all in all, decent premium generation on my part. Was able to reduce my average cost by about 3.5% since being assigned. Now moving on to Trade Desk. So Trade Desk has earnings in 2 weeks. Trade Desk had some heavy covered calls on for the week. You'll see this best in the premium right here. So earlier on in the week, you guys may remember if you saw my previous video, we had $1.72 for this Friday close. So Trade Desk as well, we got assigned at 72. We've been able to bring our average cost with the options we wrote today 10.5% to the downside. Average cost is now down to 64.39. So we pocketed most of all this $1.72. I'll show you that right here. We closed the 70s over the course of the day here today for about 17 cents. So over 90% profit on those covered calls. And then we wrote the big ones for in 2 weeks, $71 calls, very close to my strike price assignment of 72, and we got $4.32 for them, guys. That is absolutely massive premium, right? $4.32 divided by your 71 call strike, it's about 6%. 6% for 2 weeks, so that's about 3% a week. I will take that trade every single time, reduce my average cost very, very nicely. So if Trade Desk over the next 2 weeks rises significantly above 71, it'll just provide even more cushion over and above our average cost. I won't mind being taken out at 71 here, guys. If we make that profit right, 64.39 all the way up to about $71, that represents a profit of roughly 10%, and we were only assigned at the end of December here. So very, very good on a week-over-week basis of ROI generation. Now moving on to UPS. UPS getting assigned here today. So we wrote the 145s for their earnings. UPS closing in the low 140 range here today. We got $1.07 for them. So not too upset about that here, guys, today. I do believe in UPS. UPS's capacity to recover from the most recent negativity from their earnings here. So as a whole, we're now assigned 143.93 is going to be the break even. Going to be looking for a small little retrace to the upside to write some covered calls, potentially above the 145 mark. But I was assigned UPS one time in the past here, and we did make a lot of money on them. I do think that this time will most likely be the same, coming up into a big area of support. Pretty much the lower 140, mid 130 range will be the area of support right here. The next area down is a considerable amount away, 120. I don't believe the stock is going to retrace to 120. Could be wrong, but just looking for a temporary bounce of oversold conditions to write some covered calls and maybe just make this a 1 to 2 week easy play, similar to Google as well. Amazon took some profit on Amazon. As I was telling you guys, we bought these shares earlier for about $150 back in December, and now we close them for a profit. We were looking for the swing trade, right? So we bought them after we had a break of your pretty much range right here. So we were looking for the break of the $150 range. We actually broke it, retested it, and we actually smashed this right here on the breakout. We were expecting this weekly leg to take us up into the 165, 170 range. And I said, if we can get all the way up here, this is going to be the take profit area. So stayed true to my conviction. Actually closed them here today on the day for about almost $172 here at the end of your market close. So very, very happy with that performance in terms of Amazon. That's about 15% here, guys, ever since we bought those shares pretty much in early December. So very happy on that performance from Amazon. And the rest, guys, we're still holding as swing trades, right? So TMF, still have that in terms of your 20-year yield play. I still do believe that yields should be coming down over the medium to long term. So this trade should do fairly well over the next year. Ethereum and Bitcoin still waiting to average down on those. Nike, only one that's not high enough to be writing covered calls. Starbucks, Trade Desk, we covered. Baba, also not high enough to be writing covered calls just yet, but they do have earnings next week, and I may be looking to make some plays for earnings, either average down. We're going to probably looking to write some covered calls, maybe in the $78, $79 area, looking to write some puts as well, profiting from that volatility, maybe in the mid $60 range, and I may even throw another leap option on Baba. Palantir, we talked about it. PayPal, we talked about it. CSIQ, we talked about it. And my Canadian banking shares just hovering around the $20 mark. These should perform nicely when rates do come down as well. So as you can see, a lot of plays here, guys. We're sensitive to either China or interest rates as a whole, but as a whole, we've been doing a great job of writing a ton of premium in the meantime. So as soon as we get a little bit of mean reversion in these trades that are largely beaten down, if you notice, most of my companies that we get assigned on here, guys, are the ones that have just been beaten down consecutively over the course of the past 6 months to a year, because all the ones that are not beaten down that we run on a weekly basis in terms of just options that we're going in and out of usually end fairly good. They end worthless on the week, and we just don't get assigned those shares. There's one trade that I did close yesterday that I wanted to show you guys, which was CLH. We took CLH earlier on in the week. You see, guys, that we got 25 cents for the 48 puts, respecting my 0.5% rule, and we closed them the other day here for roughly 3 cents, which is kind of about a 90% profit. So all in all, very decent week in terms of premium generation. We pocketed almost about $900 in premium as a whole, and then an extra $500 on the take profit of the Amazon trade. So very good week in the portfolio. So that's pretty much everything I had for you guys today. Sorry for the long video. Had 3 earnings calls to cover. We also covered a lot of indexes and technical analysis on our major tech stocks, and a lengthy portfolio update for you guys, because I know you guys love those, love being transparent. So if you liked all of this, guys, consider dropping a like on the video. Really appreciate it. Helps me out for all of the work that we put into the channel here. And obviously subscribe to the channel if you're new. We'd love to have you here. Almost 700 subscribers here, guys. It seems as though just yesterday I was starting out on the channel with only 10 or 15 subscribers, and the video is only getting a few views. Very happy that you guys are enjoying the content. So just continue to subscribe to the channel if you enjoy what you see. And as always, guys, if you have any questions, any macro comments, technical analysis, stocks you want me to look at potentially on a video, or options questions per se, leave them down and I'll be more than happy to answer you. So take care, guys. I'll see you over the course of the weekend, where we'll be dropping a couple videos, 1 educational video and 2 the trade ideas on Sunday evening. So take a look at those, and I'll catch you over the weekend, guys. Take care. Peace.